Hello everyone, this is the fourth lesson in our series of futures trading's webinars, and we're going to focus on risk management today. This is probably the most important lesson because this is it's topics that will help you minimize risk and know when to exit and enter trades based on different risk parameters. So first we'll take a look at the slide deck. So today we're going to cover three risk metrics: Delta, Theta, and the Bitcoin value of 1%, and then we'll combine all three together and look at a portfolio of futures contracts. So Delta, in the pure mathematical sense, is the first derivative of the value of a Bitcoin futures contract with respect to price. But what we really mean in layman's terms is how much do you make or lose based on a change in the underlying spot price of Bitcoin. And when we talk about Delta in terms of risk management, we're talking about the gross Bitcoin exposure that you have. So if someone came to me and said, "Hey Arthur, what is your portfolio? What's your Delta?" I would say, "Oh, I'm long 100 Bitcoin, or I'm short 500 Bitcoin." And basically what that means is, say that you said you had a Delta of 100 Bitcoin. If the price changes by 1%, and if you're long, then you make 1 Bitcoin. If it goes down by 1%, you lose 1 Bitcoin. Generally, when we refer to Delta, it's a linear number. So a 1% movement in price will lead to a 1% movement in your profit and loss. And so today, when I speak about futures contracts, we're going to focus on our Bitcoin Quanto contracts because the payoff is linear in Bitcoin terms, so it makes it a little bit easier to understand how these different risk metrics work. So now we'll take a look at our spreadsheet and the Delta tab. So here we have a portfolio of 2 futures contracts. We have a daily and a weekly futures contracts, and we have different quantities here. So what we first want to do is construct our Bitcoin Delta. And so what we do is we compute the Bitcoin value of each futures contracts at the spot price. Very important here. You always use the spot price to compute your Delta, because you don't want to mix your Delta risk metric, which is purely dependent on the movement in price, with other things that affect the futures price, such as time decay and interest rates. So you want to get a pure measure of your absolute risk as it pertains to the change in price. So here we have an initial Delta short 50 Bitcoin of the daily and long 25 Bitcoin of the weekly. And here we see our net Delta, which is we are short 25 Bitcoin. So I want to illustrate here the properties of Delta. So let's assume that we change the price by 10% down. As you can see, our new Bitcoin Delta, 45 Bitcoin short, and then 23 Bitcoin. And what we're most interested in is the profit and loss attributed to the change in price. So basically subtracting new Delta from old Delta, and then we get our Delta P&L. And here you see the aggregate number down here, 2.5 Bitcoin. You could also take the price change times your initial Delta, and that's a faster way of arriving at the same number. Now I'm assuming here that everything moves in a linear fashion, and that's why I've used these 2 futures contracts, because it's easy to illustrate this portion. If the Bitcoin value of your futures contracts does not move in a linear fashion, then you must compute it from first principles by looking at the initial Delta with respect to the price at time 0, and then the new Delta with respect to the price at time 1. So this is a very important number. Generally, in the strategies that I've talked about previously, everything has been Delta neutral, which means that there is no impact of the underlying spot price. And that's because we're focusing on spread trades or arbitrage trades, where we're not taking an outright view on the price of Bitcoin. So if you're constructing a arbitrage spread trade, curve trade, and you have a delta that's not zero, then you're not doing something correctly, and you should analyze the contents of your portfolio and the different deltas of the securities or products that you own. So it's very important that you can calculate this number because in terms of losses, this is probably the easiest way to lose money, is not to have a clear knowledge of what is your exposure with respect to the change in the price of Bitcoin because of how volatile the price of Bitcoin is. So delta is relatively straightforward. Let's move on to theta. So I referred to theta in the previous lesson, and basically this is the daily value lost or gained on your futures contracts due to the passage of time. We also call this time decay, and basically what theta represents is a daily number, and we usually compute it in a linear fashion. So we'll take the number of your aggregate amount of time value and divide it by the number of days that the futures contract has to expiry, and then you have a daily number. So if you buy a future that is at a premium or is in contango, i.e. the futures price is greater than the spot price, you have a negative theta. That's because you've paid more for something than it is worth currently today, which means that it'll decay. So you've paid an interest rate, so you're going to pay that interest rate over the life of the contract, and we call that a negative theta. If you buy, sorry, this should say at a discount. Sorry, if you're selling your future at a premium, you have a positive theta, which means you're receiving the discount, receiving the premium of the future over spot, and every day you will accrue that interest rate that you're being paid. Now, how do we calculate the theta for a futures contract? We want to take what I call basis delta, which is basically the difference in delta between the delta calculated at the futures price and the delta calculated at the spot price. This is basically your time value, your aggregate time value. You take that basis delta and divide by the number of days that the futures contract has to expiry and multiply by -1. So if we go back to our spreadsheet on the Theta tab, again, we have our daily and our weekly futures contracts. And we're going to compute both the spot delta here based on the $500 spot price, and then our futures delta here. And now we come up with the basis delta for each contract, and then we divide by the days to expiry. So what does this mean? That means that we will earn 1 Bitcoin just from the passage of time from selling this daily futures contract versus spot. This means we'll earn minus 0.5357. Lose on a daily basis. So if you just looked on on the theta from a day-to-day basis, you are set to earn 0.643 Bitcoin each day. Why are you earning money every day? That's because you sold a futures contract in greater quantity above the spot price, and you have less days to expiry, so you're going to earn that whole difference in a short period of time. Whereas with the 7-day futures contract, you're paying this premium, this $50 premium, but you're paying it over 7 days. So the day-to-day loss is less than what you're earning from the first day. Now, once let's say that this contract goes to 0, now we have a pure negative theta because we no longer have any position in this contract, and now we're just paying away every day 0.4 Bitcoin in terms of time value. Now, this is a very important concept to to calculate your theta, because what you want to know is my portfolio making or losing money every day just from existing? Now, some trades that you put on, you're benefiting from from time elapsing, because essentially you're selling volatility, and you want time to elapse as quickly as possible so that you can make that difference that's between two futures contracts or futures contracts and spot. On the other direction, if you've bought volatility, time is your enemy, because you need things to happen as quickly as possible so that the money that you're losing, i.e. that premium that you paid in terms of theta, is made up for by a change in the direction that you were hoping for. And as I said previously, portfolios with positive carry have positive theta. Portfolios with negative carry have negative theta. Okay, BV01. In traditional finance, there's a term called DV01, which is the dollar value of 1 basis point. So I've amended that slightly for the Bitcoin ecosystem and the Bitcoin value of 1%. I talk about 1% because things move in a lot bigger fashion than in traditional finance, where you're putting on massive amounts of risk on a 0.01% move in the underlying interest rates. So what do you want to know? You want to know, how does the value of your futures contract change when the interest rates move up or down by 1%? Basically, this is the time value component of your futures contract, the interest rate component. So BVO1 is just taking 1% times your T, which is the days to expiry divided by 365, times your delta. Remember, delta is calculated at the spot price. Now, if you are benefiting from interest rates rising, that means you have a negative theta. And if you're not benefiting when interest rates rise, that means you have a positive theta. And let's illustrate this via a quick example. So now we have two futures contracts, a little bit longer dated, a March and a June futures contract. We computed our T values here, and we put in a quantity. And now we've calculated our spot futures delta and our basis delta. We've come up with our relative theta values here. And now we have our BVO1. What have we done? We've just taken 1% times the spot delta times the time value component of the futures contract. And now we have an aggregate number here, which means that looking at this portfolio, we are short something at a premium and long something at a premium. Now we can compute our, to make this a little bit easier to understand. So here we have a delta neutral portfolio. Remember, the spot delta sums to 0. And we're short something with a lower basis than what we're long. So in effect, what we want to happen is we want the percentage basis of the H16 to go down and the percentage basis of the longer dated to go up. Now, I'm just going to talk about a parallel shift, i.e. both interest rates, percentage basis per annum interest rates move up or down in the same magnitude. We want to see what that does. So now we know we have an aggregate positive BVO1, which means that if interest rates move up in a parallel fashion, we will make money on the interest rate component. So let's look at that. We move interest rates up by 10%, we'll make 1.233 Bitcoin. On the other side, if interest rates go down 10%, we lose. So even though you've sold, you have a a negative carry, a theta is negative. Here, I'll show that more clearly. So our portfolio theta is negative, our BVO1 is positive. So every day that the rates do nothing, we lose money. But if rates increase, we start to make money. And what this shows is that the theta is the entrance ticket for your rates, your interest rate profit and loss. If you want to go long rates, you have to pay time value, and you have to evaluate whether or not that daily loss is worth or will happen, or will the interest rates rise enough for you to overcome that in a timely fashion. So it's very important to know whether or not your portfolio benefits from a rise or fall in interest rates. And as you can see, the longer dated has a bigger absolute BVO1 because of the T component. So the most important factor in this calculation is the time value, or the number of days divided by 365. The longer dated of a contract that you trade, the more the price will be sensitive to changes in interest rates, and the more you have to be cognizant of the premium or discount paid or received to trade this futures contract. So now let's put everything together. So again, we have our H16 and M16 futures contracts, and we've constructed a delta neutral portfolio, as you can see here. We have a portfolio where we have positive theta. That's because we've sold the contract with at a more expensive per annum basis and bought the contract with a cheaper per annum basis. So if we were to visualize the curve structure, we have a curve, either a curve roll down because we have a positive carry because we'll receive money every day, or we have a curve flattener because we would like the long end to decline and the short end to rise to flatten the steepness of the curve. And now we have a negative BVO1, and that's because we've sold the contract with the large time value and with a higher percentage basis per annum. And as we can see here, these are the two BVO1s. Now we put this trade on, and there's different scenarios that can happen with the future outcomes, and we have to think about how we'll respond to them. The first is assume that you hold the H16 to maturity, and there's no change in the relative percentage basis per annum. So what is your theta P&L? How much money have you made? You've made 20 Bitcoin around, because you make 0.33 Bitcoin per day, 60 days have elapsed, and so this is what you have earned in aggregate on the portfolio. Wow, that's great. So now you know, if that is your trade theory, you know the maximum amount of money that you're going to make from the perfect outcome of your trade, i.e. nothing changing and time just elapsing. Second scenario, what if the daily there's a daily parallel shift in the percentage basis per annum, and you have mark-to-market gains or losses? What is the break even? I.e., if rates were to rise, what's a daily rise in rates that would cause you to break even on a daily basis? So we're making 0.33 Bitcoin each day that elapses, and you have this negative BVO1. So all we're doing is just finding out uh, at what percentage interest rate would cause us to break even, i.e. the losses on this would exceed the gains on theta. So if the interest rates rise in a parallel fashion, more than 0.27% per day, we will start to show mark-to-market losses on our portfolio. Why does that matter? All of these trades are leveraged, i.e. we're not putting up the full amount of money that each one of these contracts is worth. So we have to be very cognizant of situations that could cause our P&L to possibly lead to a margin call situation on BitMEX. What we don't want to happen is to have the trade that in 60 days is going to make us 20 Bitcoin, but we haven't deposited enough Bitcoin to withstand changes in the interest rates on a day-to-day basis. And we've let a very good trade that was going to make us money in the future possibly blow up in our face because we've gotten margin called because interest rates have changed in a way that we didn't model from the outset. So if you start to see rates changing in a negative fashion, i.e. rising in this situation, you need to be aware of what will cause your portfolio to start losing money, and at what point do you need to deposit more Bitcoin on the exchange to make sure that you can stay alive to see the trade to fruition and make make that positive carry. Now, this is another situation where we want to look at what is our mark-to-market profit and loss based on a change in the curve. Another situation which would cause us to start losing money. Now remember, we are short interest rates on the long end and long on the short end. So let's do this. At zero, we're making our theta every day. That's great. We want to wait 60 days. We want to make this 20 Bitcoin. However, things change in the meantime. Remember, we're short rates on the long end, so let's increase rates and leave. The curve steepens 10% up on the long end. We're down 20 Bitcoin on a mark-to-market basis. Now, maybe we don't have enough capital to support this trade at certain levels of steepness in the curve. And you need to know what those levels are before you put on the trade. Because if the market is more rational than the solvency of your portfolio, your positive theta trade could end up in a margin call situation where you lose your equity. Now remember, let's assume a parallel shift. Even at a parallel shift of 10%, we're still losing money. If we do want to put on a mark-to-market curve trade, i.e. we're going to exit the trade before H16 expires based on a change in the curve structure, we do need quite a bit of flattening because we have such a negative BVO1 on the long end due to the great amount of time value that it takes a much higher upward change in the interest rate of our shorter dated futures contract to cause the curve to flatten enough for us to make money. Now, these are things that you want to do before you put on a trade. If you see a situation that looks attractive, you should model it out and take a look at what could cause your portfolio to blow up before the trade thesis that you have plays out. And this is very important in trades where you're doing curve trades, because the point of a curve trade is to use leverage, and as much leverage as you can, to increase the return on equity, because we're not betting on the price of Bitcoin. The price of Bitcoin has a lot of volatility, and even with a small amount of equity, we can generate decent returns if we can call the market correctly, which, as many people have found out, is very tough to do on a consistent basis. But with interest rate trades, if we construct proper trades that give us positive carry where we don't care where the price goes, but because of the differential in interest rates, we should make money over the long term. These trades require a greater amount of leverage to achieve the same sort of nominal results. And because of that, we need to be very conscious of how interest rates can change against us that would cause our portfolio to enter a margin call situation. And so what you want to do is determine what your threshold for pain is. If rates rise to this level before expiry, I'm going to exit the trade. And you should have these limits in your mind before you put on a trade. You want to know, how much money will I make, do I expect to make in the future, i.e. 20 Bitcoin, and what amount of risk am I willing to take, i.e. in the short term, how much pain am I willing to take to achieve that result? And once you've determined that threshold, you stick to it. And the way that you determine that threshold is by taking a look at the interplay between your BVO1 and your Theta P&L. Now, there aren't any super easy tools to do this. However, you can basically model these quite easily by just constructing your simple contracts, days to expiry, multiplier, spot price, futures price. And then you can stress your portfolio in different ways. Now, the beauty of these curve trades is that once you put them on and determine what your pain levels are and how much money you expect to make in a particular amount of time, you don't have to babysit them as often. Because the spot price volatility is much greater than the volatility of interest rates and their impact on your portfolio, so you're not constantly watching the Bitcoin chart, 24/7. But you do need to know what circumstances will you need to deposit more margin into your portfolio, and understanding the interplay between Delta, Theta, and BVO1 is essential to proper risk management. So I hope that everyone has enjoyed the 4 lessons that we have presented on Bitcoin futures trading on the BitMEX platforms. These have been slightly more advanced than some of the other tutorials that we have given. I hope that everyone keeps a close eye on announcements from BitMEX. We are going to be announcing a very sexy new product related to China within the next 2 weeks, and we aim to have it out after Chinese New Year, which is in mid-February. So please stay tuned for future announcements from myself, and we'll probably do another webinar to explain this remarkable new product that we will be coming out with. So good luck to everyone, and if you do have any questions, we'll have all of the lessons posted on our subreddit feed, our BitMEX, and if you post questions or comments to the Reddit, one of us will answer them in a timely fashion, or you can come on to our troll box and interact with the community. There are some very intelligent traders on there who understand these concepts quite well and can help people navigate their way through basis trading. Thank you.